From the morning reading, selling slows as the spiders, diamonds, and Qs at short-term support. 2 of 9 sectors moved higher on Wednesday. XLU, XLP, and XLK were the strongest sectors, while XLE was the weakest sector for the third straight day. Oil futures rose 17 cents to close at 44.05. Breadth strengthened as decliners led 1846 to 1207 on the New York Stock Exchange and 1712 to 873 on the Nasdaq. Utilities are nearly at a new high. The Dow Jones Utility Average is close to a new all-time high, while other indices struggle, transportation stocks among them. This is a worrisome sign according to the textbook, since it suggests that investors see low economic growth ahead. But the other times that we've seen this kind of divergence, stocks did well going forward, especially over the medium term. Option traders are a rare holdout among the dumb money. Almost always when we see a majority of contrary indicators showing extreme optimism, option indicators are among them. But in recent weeks, option traders have been mostly defensive and not buying into the rally. This is especially the case among small option traders. When we've seen this before, stocks have risen, but it's too tenuous to consider it a positive factor. Nearly $1.5 billion has left the most popular high-yield bond exchange traded fund over the past week. The fund, HYG, has rarely suffered one-week outflows more than $1 billion. While some fund flows are not good contrary indicators, the bond funds are an exception. When there is an extreme flow, the funds most often move in the opposite direction in the weeks ahead. When there is money going, or should I say, where is the money going? Into gold partially, but also into investment grade funds. The only other time we've seen such huge outflows from HYG while LQD saw inflows was in the mid-January as stocks were bottoming. Otherwise, the two fund flows usually move more or less together. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:47 a.m. Central Time, and I'm recording this in preparation for the market day, May the 5th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And a little bit of positive action, but not terribly significant. All four broad market U.S. indices are up. S&P and Nasdaq and Dow all up about 0.25%. Russell up a little bit more robustly, about 0.33%. Crude oil, big move, up over $1 for 2.31%. Euro down about 0.2%. Bonds right at scratch, and gold up about 0.4%. China up about 0.25%. Hong Kong down about 0.33%. The Japan number still from 5.2. Their market is apparently not open. Germany up just above scratch, and the United Kingdom down just below scratch. A lot of stuff on the macroeconomic report for today, including in the United States. We have the weekly version of the unemployment claims, building permits that's Canada, nat gas storage, FOMC member Bullard speaking, and then tomorrow we have one of the big reports, and certainly the market will be looking to this, the various numbers coming out with reflecting the unemployment rate and etc. So that will definitely be something that the market will be watching. In terms of current volatility conditions, it's kind of ebb and flowing lately. Not terribly easy to pick a real trend out of this, perhaps slightly to increasing volatility. And certainly if you look at our metrics, the 5-day versus the 10-day, that is increasing. So that helps us quantify this, perhaps, especially in choppy markets. Also, you look at short-term VIX, a little over 15. Skew has dropped below the threshold, in which we call it at warning status. IV percentiles are still very, very low, with the S&P at a 15, Russell at a 16, Nasdaq 21, Dow at a 16. No standard deviation moves were put in on a close-to-close basis yesterday, though you've seen in the prior 4 trading sessions quite a bit of volatility as it has gone back and forth. One of the things to keep in note here, and I started color coding this, not just to the plus 1 or plus 2 in terms of standard deviations, but also showing negatives. So you'll see -1s and -2s, and this helps us to understand, you know, not just where is the volatility, but what direction it is. And you see here in the last 2 trading weeks, much of this trading volatility has been to the negative side. So kind of keep that in mind as well. In terms of the charts, let's go there. Here's the S&P charts, and you see we had this very clear W pattern, took off like a rocket shot, formed a nice strong channel up until the point where it ran into this very important area of resistance and then stopped practically to the tick and then started falling back from there. Importantly, it broke the diagonal and horizontal support in recent days, though yesterday it seemed to find a short-term support bottom, and so far with the overnight activity today, that seems to be holding. So we'll see where this develops. In terms of forecasting this, well, this is about as sloppy as it gets in terms of the time frames. On the shortest term, we have lower highs and lower lows, and you would expect that this would just be something of a bear flag bounce and continue down. In terms of the more intermediate term, obviously, up until the point that this area broke, we would have expected this to continue higher, but we're up against this big area of resistance, a very important area. Do not minimize the importance of that area. And until we are successful at truly breaking through this whole area, we're going to assume that it's going to continue to fail, as it has failed multiple times before. So if you're going to initiate a bullish trade, especially a bullish short-term to intermediate-term option directional trade into the ceiling here, you've got very, very tough odds working against you. So in terms of how much time does it take before that finally breaks through, it could be a pronounced period of time, or it could be the very next time. But it's bottom line, we're going to probably need some sort of stimulus or external stimuli event kind of thing to drive us through this area and finally break out above 2134. So if you're looking to initiate positions, that's a tough place to be. Frankly, a lot easier to look to the short side. So even if we are just playing inside this 300-point range, there's a lot more room to the downside than there is to the upside. So a lot of traders are probably looking for something of a bounce here to reset and reload to the bearish side. That being said, opportunity to the downside, while it could be as much as over 200 points, there's also pretty significant support to the downside, especially in the short term. You've got the cloud here. You've got multiple touches in this area here. So if you're a market profile person, I'm sure there's a big old node right in this area. So you could end up, bottom line, where I'm going with all this is we could chop around in this area here between roughly 2025 and 2100. We could chop around in that area for a while, and it would not be a bit surprising. In fact, that might be the highest probability forecast that you could have at this time based on the information that we have on these charts. Let's go ahead and take a look at the Dow. Very much the same situation as the S&Ps. Nasdaq, of course, has been significantly weaker and has actually fallen down into the cloud. So we continue to expect that the Nasdaq will continue this trend down with relief bounces by the bulls. And then from the Russell, We've come into the bottom of this channel. It looks like we've poked out of the bottom of the channel probably, but it's still in the general area. We're waiting to see, does this continue to deteriorate, or does a relief bounce take it right back into the channel and this becomes invalidated? So this one is not quite as clear as the Nasdaq. So just kind of keep that in mind. The Russell's been very, very relatively strong since it coming off of the February bottom. That being said, it's got a lot more room to make up to get towards these highs, as does the Nasdaq. So both of those, they were strong coming off the bottom, but then they also didn't come anywhere near as far back as the S&P and the more defensive Dow. In terms of current volatility conditions, very, very choppy here. You see all these trading sessions of recent, basically in a relatively small range between about 17 and about 15 and a half. That, you know, that's pretty small. And look how many trading sessions we've had in that range. 1, 2, 3, 6, 9, 12 sessions working now, where we've been within about 1.5 points on the VIX futures. Look at the regular VIX real quick. Up against significant resistance, makes it tough for it to break down in the equity markets when volatility seems to be up against significant resistance. Now, of course, they're chicken and egg, which one comes first, I get that, but you know, they're all interplaying. There's people playing the volatility markets, there's people playing the equity markets, and there's people playing combinations of the two, and they're certainly watching to see tells as to which one is leading at a particular time. And let's take a look at bonds. Bonds seemingly broke out through a lot of significant overhead resistance. Cloud breakout. We'll see if this can clear this area, get a Chicow trailing line breakout. That's this kind of big thick line right here. When that clears the price action, if the price action's above the cloud and this trailing line clears that, that's a stronger signal for a bullish move. So there's several things here telling us that the bonds could break up, and certainly that would make us expect that the indices could break down. But that being said, you know, look at the intermediate term. You know, we've got similar bottoms. We'll call that a double bottom. And then lower highs thus far. This one's not complete yet. Certainly that one was complete. So, you know, from here to here, lower high, and this one looks to be another lower high. So we seem to be forming something of a potential ascending triangle. Draw a line across here and then across the flat base. Since we were bullish coming into the ascending triangle, the expectation would be that we would break long. So another sign that bonds are telling you that the equities could be going down, but this could take a while to form. This is a pattern that has taken weeks to develop, and we're not near the apex yet. So it doesn't have to wait to get to the apex to break out, but usually a pattern that is developing like this is going to have to coil up and develop some more momentum on a breakout to be able to get out of that pattern. So we may have to be patient. And remember, when we were back on the S&P chart, we said we could chop around in this area of about 75 points. When we go back to the bonds, that tells us very much the same thing. We could chop around for a little while before these markets make a big move out. Right now, the big move out would be expected to be bonds up, equities down, based on what I'm reading on these charts at this time. But a lot of things could change between now and the time that that would develop. And we'll take a quick look at gold. Gold, of course, did have that pattern breakout and seems to be forming a bull flag. So we would expect that at some point this would be in a continuation pattern long. So while it is retracing, the suggestion would be to be patient right now, and then if you're not already in this trade, to consider setting up an entry on the next breakout of the flag pattern. Okay, let's go ahead and go to the daily report. We continue to see deteriorating conditions come into this daily report. And one of the things I stress to those of you who are following us on a regular basis and ideally listening on a daily basis, while it may seem oftentimes that there's not a lot of change from one daily report to another, it is in the subtle differences that it is the important thing to pick up, because you'll see that change come in and then the rate of change increase as conditions deteriorate, and that's how we manage risk and affect our investing and trading behaviors in a way that allows us to make the right moves at the right time. Well, we saw a number of trading sessions ago where this went to, on the intermediate term, phase opinion to phase 5, which is a bearish sign. The in short term is our short description, the break of diagonal and horizontal support. That was a very important warning sign. We also saw a number of trading sessions ago, I guess about 9 now, where uptrend under pressure from IBD, one of our first of 3 mechanical signals signaled, and we've seen continued deterioration there. With today, our second mechanical signal, the GMI index, went to a sell signal. So it's scored as a 2 out of 6 and a 1 out of 8 on the more sensitive GMI2, but officially went to a sell signal with the close of 5-4. Also, in another sign of deterioration, with our third market timing signal, comes to us from Stock Charts Decision Point Scoreboard. We had new signals on the short term in both the S&P 500 and the Dow, deteriorating on the trend model signals on the short term window to neutral. So now isolate to the short term: neutral, bearish, neutral, bearish, neutral, bearish, neutral, bearish. So significant deterioration on the short term across all these markers, and you're up against, in the long term, a mixed signal on all 4 of these markets. And the intermediate term still holding up officially with bullish conditions, but this is about as sloppy as you can make it on the decision point scoreboard in terms of getting a stack of agreement in terms of the signals across the different time frames and across the different indices. So when you put all this together, the consensus of these mechanical signals is clear that it's a market in transition, first and foremost, but there's a very clear rate of change and increasing rate of change that is pointing to the bearish side. So you've got to pay attention to that. Position sizing opinion right now, no change from yesterday, 50% on the portfolio signal, and on the active trader volatility based system, 75%. Intermediate term market posture continues to deteriorate. You have on the S&P and the Dow just barely above 50. If this drops below 50 in one more weekday, could do that, this would go to strongly bearish. And you see Nasdaq is already at strongly bearish, and if it drops below a 20, it'll go to severe bear territory. And of course you have the Russell holding up in a relative terms a little bit better. It is also weakly bearish. So all 4 of these are in the bear camp now, and some of these are starting to become pretty significantly with some strength to the bear side. In terms of our hedge warning status, we're still at level 1+, which is caution with an increasing number of warnings firing. In terms of special opinions, no changes from yesterday. VIX is technically inside the acceptable window to initiate new positions. However, with these multiple other warnings, we suggest significant defensiveness on the initiation of new positions. Covered calls and put selling conditions not acceptable to initiate new positions for novice traders. Clearly, with an intermediate term market posture that is bearish, it is not the time to be setting up new bullish positions. Now, the more aggressive traders, you might be looking for opportunities to sell against some of your favorite trading positions and set up new puts or new put spreads. Strongly consider defined risk positions using those put spreads instead of just naked puts at this point. And then the other aspect to this is make sure you keep that in the scale that you're willing to own. We actually had a couple of these warnings ebb off yesterday. The first two here actually went back to normal situation. Volatility ratio warning, though, fired 2 sessions ago, and we're looking for an increase of volatility based on that signal. Distribution day count, I could not pick up a new count on that. I am not sure if we had a distribution day yesterday or not, whether this increased or not. This actually is D-1 in terms of that count right there. Skew actually dropped just below 125, so that one also ebbed off. The 10-day out expected moves right at 40, so right at warning status there. All 5 key intermarket risk aversion indicators are still on the risk off stance. And then from sentiment, we have medium-term risk on stocks, and bonds are also at elevated sentiment level. Fear and greed index continues to work its way down towards the neutral. It's now at 57. In terms of sector specific, just look at the deterioration that we've seen here in the short to intermediate term across the various sectors. Only consumer staples and utilities are holding up, and you see the performance yesterday. Utilities up over 1%, consumer staples up over 0.25%, and then also defensive telecom was also positive. So definitely the money is either rotating to or holding into the more defensive areas of the market as of late, and you see the 5-day as well, and then into the 1 month there. While negative, they certainly are relatively benign and much more consistent in their performance, and that sometimes is of value to investors as well. Not just where do you end up in terms of your growth, but what is the consistency in the performance across various time frames, and how well you hold onto your positions. Okay, that's probably enough for today. We have been a bit long, so let's go ahead and wrap this up. We're going to just scroll today. If you need something more, just hit the pause button, go to the hyperlink, and get the additional information. A lot happening right now, so we hate to cut too short when we think we've got something of importance. Other days, things get a little quieter and we can be a bit more concise. Disclaimers, as always, hit the pause button if you need more time to review. And then as always, you see the full disclosures can be found at this hyperlink down here at the bottom. We'll see you back here tomorrow morning with the Falcon Global Market Preview. Good trading.